It starts with a single strike. A headline flashes across your screen. United States launches military action against Iran. Oil markets react within seconds. The S&P 500 plunges. Bitcoin spikes. You check your portfolio, and suddenly, the world feels unstable. But what exactly happens when a superpower like the US attacks a nation like Iran? And how does it ripple through the economy, the markets, and your investments? Iran isn't just another country. It sits on one of the largest oil reserves in the world. It's a strategic player in the Middle East with influence across Iraq, Syria, Lebanon, and Yemen. And most importantly, it borders the Strait of Hormuz. That narrow passageway is where nearly 20% of the world's oil supply travels daily. If that choke point is threatened, the global economy starts to hold its breath. Whenever tensions between the US and Iran escalate, the very first market to react is crude oil. Even a minor incident, like a drone strike or a tanker seizure, has historically sent prices soaring. Now imagine a full-scale attack. If Iran responds by closing the strait or attacking oil infrastructure, oil prices wouldn't just rise, they could explode. We're talking 30, 40, even 50% spikes in a matter of days. And that doesn't just affect gas at the pump. It ripples through airlines, shipping, logistics, food prices, and ultimately inflation. When oil rises fast, everything else starts to break. Central banks are already walking a tightrope between fighting inflation and supporting economic growth. But a geopolitical oil shock? That throws off the entire balance. It forces central banks like the Federal Reserve or the European Central Bank to delay interest rate cuts, or worse, consider tightening again. And while they may try to maintain calm, the bond market doesn't wait. Yields start jumping. Debt gets more expensive. Consumer confidence drops. But it's not just oil. When war hits, money moves. And fast. Institutional investors pull capital out of risk-on assets like tech, emerging markets, or growth companies. Defensive sectors take the spotlight. Military contractors, energy companies, and commodity plays. Stocks like Lockheed Martin, Northrop Grumman, Raytheon, Chevron, and ExxonMobil suddenly become hot buys. Meanwhile, tech-heavy indices like the Nasdaq often see sharp, short-term pullbacks. Not necessarily because the companies are weak, but because fear changes everything. And then there's gold. Gold has always served as the ultimate hedge in times of crisis. When bullets fly, gold shines. In previous geopolitical shocks, from the Gulf War to the US invasion of Iraq, gold rallied double digits. It's not just about speculation, it's about trust. When people lose trust in fiat systems, in peace, in the predictability of markets, they move into gold. That same logic is starting to apply to Bitcoin. While Bitcoin isn't yet a fully proven war hedge, it's increasingly seen as digital gold, especially in countries with capital controls or unstable governments. Now, what about Iran's allies? If a US strike on Iran escalates, you can expect regional flare-ups. Proxy groups may target US forces in Iraq or Syria. Hezbollah in Lebanon could open a front against Israel. And Iran might receive silent backing from powers like Russia or China. Not militarily, but diplomatically or economically. That adds complexity to the global order. Sanctions may tighten. Trade routes could shift. International relations grow colder. That affects multinationals, exporters, and supply chains, especially in energy, semiconductors, and raw materials. You also have the cybersecurity angle. Iran has advanced cyber capabilities and has previously targeted US infrastructure in retaliation. In a modern conflict, bombs aren't the only weapons. Digital attacks can shut down pipelines, power grids, financial systems, and spark chaos without a single soldier crossing a border. That's why cybersecurity stocks like CrowdStrike, Palo Alto Networks, or Fortinet often see spikes during military tensions. Investors want exposure to digital defense. The bond market also becomes a battlefield. When war breaks out, there's a sudden demand for US Treasury bonds, seen as the safest asset on Earth. That demand pushes yields down, at least temporarily. But if conflict lingers and inflation stays high due to energy shocks, those same bonds could sell off, pushing yields up again. It's a strange, volatile dance, safety versus inflation risk. And it's why volatility indices like the VIX usually spike in these moments. Fear becomes the dominant force. Let's talk about the US economy itself. War spending isn't cheap. If a conflict with Iran escalates into a multi-month or multi-year operation, the US could face hundreds of billions in additional defense outlays. That money has to come from somewhere, likely from more debt. That raises concerns about fiscal sustainability, especially with an already large deficit and rising interest payments. Ironically, defense stocks benefit, but the broader market may suffer if investors lose faith in Washington's financial discipline. What does this mean for you as an investor? It depends on your time horizon and your positioning. If you're heavily exposed to growth tech, expect turbulence. These stocks are sensitive to interest rates, consumer demand, and global sentiment, all of which get hit in wartime. If you hold energy, defense, or commodities, short-term tailwinds could be strong. But don't confuse that with long-term stability. War-driven rallies tend to fade when peace returns, and then there's emotion. In times like these, the biggest risk isn't geopolitical, it's psychological. Fear makes people sell at the bottom, buy at the top, and abandon rational plans. The best investors stay informed, stay calm, and understand the mechanics behind the chaos. So, how does a US strike on Iran affect the economy? It affects everything. Energy, inflation, interest rates, trade, digital infrastructure, currency markets, investor sentiment, all are in play. And while the headlines may focus on missiles and retaliation, the real story plays out in markets, portfolios, and boardrooms around the world. You don't need to be a geopolitical expert to navigate this, but you do need to understand how global events translate into money movement and how to stay positioned in the chaos. If you found this breakdown helpful, hit the subscribe button. This channel brings you high-level finance, macro, and market analysis you can actually use. And tell me in the comments, how would you invest during a